Good morning and good afternoon, and thank you for joining us for today's webinar brought to you by the Worldwide Network by Dun & Bradstreet. So today we're going to explore the global bankruptcy trends we are seeing today and asking the question, will 2022 be the year of financial reckoning? We are joined today by two of Dun & Bradstreet's most senior experts. Firstly, Dr. Arun Singh, Dun & Bradstreet's Global Chief Economist, and Tim Vine, the International Head of Finance and Risk Solutions at Dun & Bradstreet. We will host a Q&A at the end of the session, so please feel free to submit your questions throughout the webinar, and we will get to those at the end. Thank you very much, and I will now hand over to Arun to kick us off.
Thank you, Louisa. Good morning, good afternoon, good evening, depending on the market which you're dialing from. You know, as Louisa said, that we are going to talk about global bankruptcy trends. And most of you might have seen last year in 2021, from that perspective was not that bad. It was in fact good year. Why it was good year? Because there was a lot of support we had from the government side, the policy makers, decision maker, all were out in the market supporting companies. And given the extreme level of support we have seen in 2021, it was great from that perspective. But in 2022, today, we have heightened uncertainty, elevated concerns. Companies across countries are asking very prominent questions that what the future look like, what 2022 look like, because I think we are still not out of pandemic. We are in middle of what we call Russia-Ukraine conflict, and we are at a risk of serious slowdown and the interest rate going up. Inflation is multi-year high in many countries, and there is a serious risk for the company's perspective and talks about the profitability, even talks about their growth plan. They're talking about the leverage. There are many elements we basically can foresee going forward. With that, we have come across this theme to present to keep all the companies, a customer as well as relevant stakeholder to update it in terms of what's happening and what we feel about bankruptcy going forward. Now, when you look at 2021, I just said that it's not a bad year. In fact, it was a good year. And after 2020, the base effect, there was a serious improvement we have seen in the economic front. So as a company. If you go on the next slide, please. Yeah, if you look at major economy in 2021, the bankruptcy actually declined. And that's because there are many factors was at play. There was some economies, in spite of the support, there was a bankruptcy gone up, but those are economically not big economies. There are small countries from a GDP contribution perspective. But the large economy, whether you talk about the China, US, Japan, France, Germany, South Korea, Netherlands, these are the economies where we have seen a large scale drop in the bankruptcy trend. Why bankruptcy have declined in 2021? I'll give you some of the parameters which will give some idea that what we should be careful and watching in 2022 and going forward in order to manage our portfolio, in order to manage the customer side issues as well as the vendor side issues. Can you go the next slide, please? Yeah. So one of the serious things happened in 2021, given the fact that interest rate was down, given the fact that government across countries supported the companies, global debt securities gone up to the record high. It surged by 22.1 trillion US dollar in just 5 quarters. Historically, that amount took 17 quarters as an incremental level. But during pandemic, after the Q1 2020, when the pandemic started and when the lockdown enforced across countries, you can see the jump. There's global securities. In fact, the companies actually bought the money. There's basically the debt has gone up, shot up tremendously. So there's abundant money, abundant low cost liquidity was available in the market, and that provided a support to overall the capital market in 2021. Next slide, please. That was result of the average policy rate, across select countries on the planet. This is something around 40 countries, most important countries on the planet. The average interest rate is going down. The last decline in the average interest rate we have seen during the financial crisis period, that 37 percentage point. After that, it was gradual fall, but it was almost stagnated towards end of 2019. But 2020 have seen again 45% drop in the average interest rate. That's basically provided a support to the businesses to survive during the pandemic. Next slide, please. Yeah. And from the government side, there's another support came in, what we call the easy flow of money in order to have a fiscal support. This all the countries put together. There's a government support as a percentage of the GDP, if you look at, that was just 2.6% during global financial crisis. So far, before pandemic, we all have referenced against the global financial crisis, one of the serious crises of our age, which we have seen, which impacted companies across the countries on the planet. But during COVID-19, we started saying that it was one time in the century. That's how nearly 30% of the government support of GDP given to the companies, given to the people, just to keep them afloat, just to keep them going on. And there were some then there were some policy changes happen across countries that you don't have to basically file the balance sheet with the stakeholder, with the government authorities or the decision maker every time. There is a space being provided to avoid hostile takeovers by the predatory firms. There are many regulatory changes done. All this, whether talk about interest rates, we talk about the fund availability, low cost fund availability, and the fiscal support, and then policy support from the government side, everything contributed to the health of the companies. And as a result of that, you can see the bankruptcy level have declined in 2021. Now, how 2022 look like? All these parameters we need to be very careful in 2022 and how that's trending. Let me explain that one by one. If you go on to the next slide, please. Next slide. Thank you. One single most parameter which we watch from top is a GDP growth rate. If you look at global GDP growth rate is very volatile. Of course, it goes back to the last 5 crisis periods, starting from the Arab oil embargo issues during the high inflation phase. That's how most of the countries started feeling the pinch in terms of the inflation. It's a multi-year high. Some of them the highest since 1970. That time GDP fell down, but it quickly recovered to the average point. Not that, in fact, it didn't slip to the negative GDP growth rate. Then we had the oil price shocks during 1982-83 and Latin America debt crisis. Again, GDP fell down, but it was positive GDP growth rate. Then we had the Gulf War, credit crunch. Sorry, again, GDP was a positive decline, but the positive asset bubble, the 2008 8-9 crisis we had. That was the first time for a very long time period we had seen the GDP moderating, or in fact declining, and less than 0% growth we have seen. And now it's why we are calling it all-time high in terms of the COVID crisis and then Russia-Ukraine conflict, is that GDP is now plunged significantly in a red zone. But equally to recover, because very next year in 2021, it's gone up to even the more than average rate, is because adjusting to economic shocks. Why? Because there was no economic shock. It was a health crisis because there was a demand, there was a pent-up demand, there was a consumer confidence was anyways very high. It was just health crisis created a pain, and the moment health crisis issue resolved, or we reach some consensus that is not a major concern at this point of time, GDP quickly recovered, what we call a serious V-curve recovery. But then Russia-Ukraine conflict started, and our GDP again in 2022 and beyond not looking that great. In fact, it's still on an average of long-term average. This does not account for a serious implication, what we can see in terms of high inflation and the consequent increase in the interest rate going forward. This is the space I think we should be very careful in watching that what future look like. Next slide, please. Yeah. If you look at, because of the Russia-Ukraine conflict and the inflation shooting for some of the countries all-time high, multi-year high, and interest rates going up, there's a delayed recovery on the GDP front. Earlier, we thought that in 2022, most of the countries will recover. Now, there's most countries now delayed. Only 45% of the countries are going to achieve per capita level of 2019 in year 2022. Rest of the countries, it's delayed, it's beyond 2023. In fact, 42% of the countries going to achieve 2019 per capita level, what they have achieved after 2023, which is basically loss of economic output for almost 3 to 4 years. One can see the pain coming ahead of us in terms of the loss, because these 42% of the countries are going to be losing most other than the rest of the 45% of the countries, because they might have recovered in 2022, but these economies, 42%, are not going to recover before 2023, which means they have a serious issues in terms of growth going forward. If you can go down. Next slide, please. Yeah. Why this is going to be a pain in terms of the recovery, what we are expecting, and this is the space we should be careful and watching as a result of the COVID-19 and the follow-up action, during the Russia-Ukraine conflict. You can see the supply chain pressure index has shot up. It's gone up. It's a multi-year high. It was very high during 2020 and some part of 2021 early days. It's improved. It's basically normal when people started going back to work and there's no issue around that, around the lockdown and other element. Then Russia-Ukraine conflict started. That again pushed in terms of the commodity movement, in terms of the sanction, in terms of the other issues. And then again, some of this, closure of the port in Asia, supply chain pressure index gone up. That have created a scarcity, that have created some commodities shortfall on the global platform. As a result of that, if you see on the next slide, inflation across countries have gone up. Canada, for example, if you see the consumer price index, while demand, one can see, has picked up some of this country, but it's not great enough to keep your inflation very high. Now this inflation is looking more from a supply side crisis, looking from the shortage of the commodities on the global map. And as a result of that, if you look at the Canada inflation rate is highest since 1991, France highest since 1986, Germany, if you see, the highest since 1974. US, in fact, if you see, the highest since 1982, UK highest since 1990, and Japan highest 2014. These 6 countries, there are many more countries were multi-year high, but these are the important countries. These are major economies because they contribute majorly to the world GDP, and in fact, they also contribute to the overall commodity prices. It's worth to watch these countries. These countries are facing serious issues on the inflation front and the consumer price index. And if you can go on the next slide, please. Why it's a serious concern? Because energy and the food prices, what we have seen today, is going back to what we have seen in 1970 during Arab crisis, when the oil embargo happened and there was some serious issues about the price side, and then other worldwide stagflation we have seen. We are slightly heading into towards that trend. You can see the map. We are close to that level of inflation. If you can go on to the next slide, please. Yeah, and as a result of that, if you look at, if you look at what you call the traditional monetary policy approach, traditional central bank approach, in order to control inflation, the monetary policy, the monetary authority, they resort to the monetary policy and the rate hike. And that's basically going to create a pain, because if inflation is cited as one of concern to the reserve, to the central bank of the particular country, that's going to, that's going to change the interest rate scenario in this country. For example, something around 91% of the countries which we looked at, around 43 countries, they see inflation target above what they have earlier projected. So that's a serious issue, because they see the inflation going up. And global real interest rate, if you see, it's a negative. It's a negative after, during financial crisis, what you have seen in 2008 and 11, and during 1975. So it's a, it's a second time it's going down. If you can go second slide, please. As a result, I just said that the central bank across countries will resort to the monetary policy approach to control inflation rate. And if you see 80% of the countries, what we have looked at across 37 market, they have increased interest rate in recent months. And some of those countries have increased very surprisingly very high rate. And that's not good for the company operating in those countries, because that's going to certainly increase the lending rate for sure. And as a result of that, average policy rate, if you can see, this was one of good things happen in 2021, where average interest rate is coming down. That trend is now getting reversed. The average interest rate, average policy rate is now going up. If you can go next slide, please. Yeah. Why I'm saying this time is a serious concern, why the government support is not expected the way we have seen during 2020 and 2021 because of the global debt stock. It's all three segment of economy or the planet got impacted. When we talk the household debt, it's gone up. It's manageable. It's more or less there, what we have seen in 2009 during the financial crisis. But if you look at the private debt, as a result of lower interest rate and the support, it's gone to 98% of their 98% of that particular country GDP. Look at the surge the private companies have borrowed. And the public debt, it's again gone up to 99% as against 75%, which means the government as well as companies have literally borrowed so much of money, is looking slightly unsustainable for those companies and the government. If interest rate goes up, the debt servicing is going to be a problem now, which will have some capital outflow risk in the emerging market and developing economies going forward. If you can go down next slide, please. Why I'm saying it's a serious concern for some of those advanced economies, given the public debt issues. The public debt today during pandemic days and the recent what we have seen today, it's equivalent to what we have seen in the World War II level. Look at the surge in the public debt, and the public debt today is coinciding with what you call serious risk of slowdown and the higher interest rate, higher inflation rate. In that event, the debt serviceability will be a problem, not just from a company perspective, also from a country perspective, which means there's a serious risk that the government will not invest too much of money into the economy for supporting the company, which means whatever freebies, what we can call it, was announced by the government is likely to be rolled back gradually, and that will create a problem for the company on the ground. If you're going to go on the next slide, please. When I talk about share of vulnerable firms, because one side the companies are exposed to the debt, but when I talk about share of vulnerable firms, these are the companies across automobile, component, consumer services, consumer durables, apparel, transportation, energy. These are the company who basically very low on return on asset, in fact low profitability. They're leveraged and they're exposed to go bankrupt or exposed to face some heat as we move ahead. had shot up, recently in 2020 and 2021. It's gone down, but still very high. In fact, it's still, in fact, higher than what we have seen in last 10 years in terms of the average. So there's a serious risk from the company perspective, which is emanating, which means is going to create a pain as we move forward. Next slide, please. Next slide. Yeah. Now, as a part of something, I would say that just summing up, or maybe the part of the last leg of the conversation, this is one of our score which we calculate for many countries across all the companies which we have in our database. This is the basically global business ranking, which talks about the probability of business becoming inactive in next 1 year time. If you look at in 2022 so far, the percentage of a company in the US, Germany, India, and Russia. These are some examples just for a real estate purpose, just for the space of this slide. We just selected a few countries, but that global business ranking is basically deteriorating. It's basically going towards the high risk side, and the more and more companies are part of this one. Now, if you look at the 2021 was a great year from a support perspective. Inflation was down, interest rate was lowest we have seen. There was a huge support from the government side, either from the fund side, whether I talk about the hard money, hard support, or the regulatory piece. There's good support we have seen. In the 2022, everything's getting reversed. We talk about the high inflation period, GDP is moderating, there's a delayed recovery, there's a slowdown, there's risk of serious hard landing in some of the countries expected. There's a political concerns happening in some of those countries. We have seen there's a higher level of cost given the fact that interest rate across countries going up. The serious level of what you call bankruptcy in the sense global business ranking, the probability of inactive is going up. All these things is getting reversed in 2022. This is space I think we should be careful. There are serious risks that if this continue, there will be a problem. There are economies one can see have seen the improvement. And there's a reason that the countries have managed in order to provide that support and have a qualitative as well as quantitatively. But this is space we should be careful because I think none of the companies are isolated. They're linked either globally, either to the same market they're operating, but somehow they're interlinked. So as anything happening on the global space is going to touch and impact each and every corner. With that, I will close my remark. And now I have my colleague team who will share in this scenario how to basically act and what business leader, finance leader should work upon. Over to you, Tim. Thank you.
Arun, thank you very much. Very insightful as always. It looks quite a depressing outlook, but what I'm going to try to give a perspective on is how to navigate through that. As Louisa said, I head up the International Finance and Risk Solutions here at Dun & Bradstreet, covering all aspects of risk from financial and credit risk on the customer side to supply chain risk and regulatory compliance risk, as well as fraud and cyber and other component parts of that. And what I'm going to touch on today is a perspective of how to manage through these uncertain times, particularly from the customer financial and credit risk perspective. As Arun said, and I share this perspective, there is a lot of hidden risk right now in the economy and in the marketplace globally. As COVID backing and COVID loans start to need to be repaid, as well as all the other macro factors Arun talked through, this will undoubtedly have an impact on the ability of companies to remain solvent, also the ability of companies to service the credit terms that they've been granted. So I'm going to try and give you a perspective looking forward. So Louisa, next slide, please. Now, it always surprises me as I talk to clients around the balance of focus within organizations when they look at the risk of new customers and the risk within the existing customer portfolio. And if you think about it, the risk only exists once you've extended a commercial relationship with a business, once you've extended credit terms, once you've provided goods and services in advance of being paid. That's where the true financial risk lies, because you've provided your products and services to your clients and they haven't yet paid you in return for that. That's the true financial risk in the book. And particularly in uncertain times or in times heading towards recession, it's a time to look and take stock of your existing customers. And that's always been the guidance that DNB's provided. Manage the risk of your existing customer base. And that's by looking at a combination of what you know yourselves around how your customers are paying you, servicing you, managing the accounts receivables, but also how those companies are paying others. And that's the perspective that DNB can help to provide. How are customers paying others versus yourselves? Are they in a position where they're choosing not to pay you because they're paying somebody else first? Or are they in a position that they can't afford to pay anybody? Who will continue to pay and how will they pay? And which businesses will remain in operation or are more likely to fail, particularly as COVID-backed loans and government-backed loans start to need to be repaid? That puts additional pressure on the cash flow of the businesses that you're providing goods and services to. So first and foremost, the guidance is to take stock of your existing customer base, understand trends and themes across your customer base internally within your business, and also the external context of how they're operating with others. Secondly, minimizing risk, and that can cover both new customer onboarding as well as managing the existing customer base. This can look at adjustments to your credit policies, adjustments to payment terms, making sure you strike that right balance so you ensure you have profitable relationships going forward with your customers, but trying to identify the slow payers between can't pay and won't pay, trying to understand where you should prioritize your collections and your receivables management policies. Maybe there's an opportunity here to review your bad debt reserving strategy in terms of what money you put aside for companies that do go bust. And during tough times, it may be necessary to increase your bad debt reserve. Prepare for that rainy day, because as Arun said, the rainy day is sure to come. And on the new customer side, you don't want to add bad customers on top of your existing base. So particularly as we look to go into tougher economic climate, understanding and reviewing the policies that you have for onboarding new customers and reviewing those policies. Maybe it is a case of asking for tighter payment terms, but also if you go too far, you may find that companies aren't willing to purchase from you on credit terms because they simply can't afford to pay according to the terms you're setting. So it's all about balancing that seesaw between kind of risk aversion and risk tolerance. And last but not least, around automation. And why I think automation is particularly key in uncertain financial times is it really enables your most skilled, most experienced people to spend time on the most important decisions for your business. The ability to automate the regular, standard, straightforward decisions, reviewing customers that are financially very strong, or on the flip side, financially very weak, that's quite a straightforward decision to make because the indicators are so strong. It's the middle ground, the grey area in the middle, particularly if they're particularly key clients for you, particularly large or on a particularly important part of your business, or the payment record of those existing customers has been inconsistent and volatile. That's where the skill is needed. That's where the experience and the human intervention is needed. And if those team members are spending their time on the easy decisions, they're not able to spend the amount that they need to spend on the more important decisions. So automation is a way to free up and liberate the resource to enable the right decisions to be made on the toughest decisions. And the combination of those three factors should give you a fairly robust approach to managing through financial uncertainty. Now, Louisa, if you can move to the next slide. And these are some of the practical ways that we advise customers to help to do that, particularly focused on the existing customer base. Generally speaking, 80% of the time spent up front onboarding new customers and 20% of the time spent managing the risk of the existing book. In uncertain times, I would recommend flipping that completely around and spending the vast majority of the time really understanding your existing customer portfolio. And that can be achieved in a whole number of ways, but just three to call out here. And it's really under the banner of portfolio insight. You yourselves know your view of your existing customer base, how they pay you, the age of the debt and the size of the debt, and the experience you have with each of your clients. The third leg of the stool that you might be missing is how those businesses are operating externally, how they're servicing others. So combining your accounts receivables data with the information that Dun & Bradstreet can provide, our data and our analytics to understand that trilogy, that three-part combination of age of debt, size of debt, and risk of debt. And that's just not just risk to you, but the risk to others. That can really help to truly understand hidden areas of risk across your portfolio and drive cash management strategies when you're thinking around how to collect and how to bring that cash into your business. Secondly, a very, very powerful technique is to get ahead of the curve. The historical approach to existing customer risk management is to run a credit check maybe once every 6 months, maybe once every 12 months. The point I always make is, what happens if something significant happens the day after you conduct that annual review? You may be blind for the rest of the next year. So flipping that around and really managing based on change and alerting and monitoring key changes across your customer base so you take action where action is needed. The phrase of managing by exception rather than managing by default. If you can really, again, focus your key resources on the key changes that matter rather than an arbitrary annual health check, then you will get ahead of the curve. And when you're starting to manage financial risk in your book, you may well be one of the first creditors in line to be paid, because you're at the front of the queue. You're on top of your evolving risk across your customer base because you're using early signals and early signs to take action. And then thirdly, really understanding insights across the entire portfolio. Understanding trends, understanding themes, looking at your customer base as a collective rather than as a set of individual customers. You'll be able to then define your cash management strategies as well as KPIs and reporting across your business. And on the flip side of the negative, there is a positive story here for sure. You can start to uncover companies that are thriving during these tough times. And maybe you can look to extend and grow your commercial relationships with those clients to counteract any risk you might see as some of your customers might fall off as they start to pay you late or start to pay you not at all as they experience business failure. So really, I think the key theme here is as we go into uncertain economic times with everything that Arun laid out, I would put so much more focus on managing your existing customer base. Of course, you need to take on new business, but really the risk lies within your existing base. The risk doesn't lie within businesses that you haven't extended relationships with. That's risk for the future. The risk for now is in your existing customer portfolio. And hopefully that gives you a perspective as to how to kind of translate the macroeconomic view that Arun has laid out into a very kind of hands-on practical approach to managing the risk of your existing customer book. So with that being said, I'm going to hand back to Louisa, and I think she's going to wrap and then turn it into the Q&A.
Thank you, Tim, and thank you, Arun. Thank you so much for sharing all your insights today. That's been fantastic. So we've had a few questions in, so I think I will dive straight into those. The first one we've got here is, in your opinion, how should the various governments tackle the current situations, inflation, supply side impact?
Yeah, thank you. Thank you for questions. I think there are many ways, and most of government already started looking at this one. There's a need to counterbalance of increasing interest rate as a reactive way to manage the expectation well. We need to understand the current inflation rate is not driven by a demand side. Actually, it's a supply side issues. The government across countries needs to work around to resolving those supply chain issues to take out those problems, what we have seen, the scarcity on the goods, and that basically navigating the commodity commodity availability, working with the rest of the government or other country, other suppliers. So that's one thing, because when you mistaking in terms of higher inflation rate, because of the demand side pressure or supply side pressure and increased interest rate, that will somehow manage your inflation rate, but that will create a downside pressure in terms of the higher interest rate and will kill what we call nascent economic recovery in your market, which means the government across country has to look at inflation from the root cause perspective rather than reacting to the interest rate, and sometime wait and watch policy matter that that works better rather than too reactive. It's not that there should not be a struggle to stay ahead of the curve from the interest rate cycle. I think most of the countries have done that one, but I think there is a need to relook at from that side, depending on what is the issue in your country, rather than just using this one, because I think there's a fine balance of looking at, is it the demand-led problem, or you're not going to kill the productive sector of your country, and or there's the heated economy. And once you are able to define that there's a supply side issue, there's a heat in the country, or then there is a recovery piece. There's a recovery, or there's a national recovery in the country. These three P's one has to be looked at very carefully before having those interest rate instrument used. But it will have a it will have a different government taking a different approach to manage the crisis.
Great, thank you, Arun. We've had another question, which is, I think, referencing one of the charts you showed earlier about why you see that China is improving in 2022. And I think related to that, to another question is, what do we think the impact is going to be of China's zero COVID strategy, obviously, to the world economy?
Great question. I think if you look at in 2020 GDP growth rate, China was the one country, the big country, I would say, amongst the planet, who had a positive growth rate against all the economy. Almost everyone had a negative growth rate in 2020. That managed well because of the China during the first wave of the pandemic recovered very quickly, and they were back to the economic trajectory. And there was a massive support by the government authority, and they managed well. Pretty much 2020, 2021, or maybe early 2022, you can see it was fairly going great. And that has contributed to a lower level of bankruptcy so far, because this data is, again, you can say that part belongs to that piece. Now, coming back to the second part of the questions, I think you started showing the impact. If you look at, some of the sport operation was impacted, and that your supply chain pressure from Asia to the West Coast have, going up. And that will certainly have some impact on the economy. I think government is working in order to manage those impacts. But from a rest of the world perspective, I would see serious implication on the supply chain. And that's what you can see. One of the chart was showing the supply chain pressure index shot up again after improvement in 2021. So that's going to have some impact for sure, not just the economy, also the rest of the world where the China is exporting the goods.
Great, thanks, Arun. We've just had a question in about, does the exchange rate fluctuation play a key role in the risk matrix for businesses in developing countries? How can this risk be managed?
Yeah, that's a very good question. Again, coming from hedging side, you can see, I think more than appreciation and the depreciation of a currency, what is impacting a country and the company per se is that the volatility in the currency. Any currency, if you see, there is recently the surge happened, the dollar strengthening across all the against most of the exchange rate. In fact, when I was looking at the data, there's a parity now. Euro is now close to the dollar, and the GBP basically depreciated. Most of the countries have depreciated. That's basically certainly create a pain when you are basically involved in the cross-border transaction and what do you call the currency currency trade involved in that from that side. Now, looking at that, and it's very important to see whether crisis is coming from the US or the North America side, or the crisis in the rest part of the world. We have seen 2008 and 9 and other crises. The dollar strengthens actually, and the capital flows back to the countries, and there's a serious risk. And I have basically presented earlier. If you see, is the Fed after the Fed increased the interest rate, there is serious risk of the capital flow going back to the country. It's again depend on the country to country, which country you belongs to. I think at this point of the hedging is what you recommend. And I think keeping your position open is certainly going to be a very serious repercussion on the operation, because I just said it's not about appreciation and depreciation, it's about the volatility, because you don't know how much of the volatility create a impact on the trade in the currency front. And there's a discussion happening around this one, and it's too early to see most of the country after the sanction on the Russia looking the local currency trade, looking for the other, other than the dollar trade in the sense because of the Russia coming out of the SWIFT. So there are currency fluctuation, there are currency seriousness one can see. It's always better to have those hedging done. Or else I think next couple of years is going to be I would say, slightly concerned from the currency front in terms of the volatility side. Thank you.
Thank you. A couple more questions coming in just before we close up the session. How do you see food shortage affecting the economy to come this year?
I just missed that question. Can you please?
Sorry, how do you see food shortage affecting the economy this year?
Of this year?
Yes.
So I think this year is not going to be what we have seen in 2021, or most of the global firms, most of when I say firms, the research houses, whether talk about the IMF or talk about the World Bank, whether talk about any other research organization, when they projected world GDP growth rate end of the 2021, it was not that bad. Now, early part of 2022, we have seen Russia-Ukraine conflict, and the Russia-Ukraine conflict now reminded us the days of 1970 1970 Arab oil embargo issues and the concern we have seen. And inflation trajectory is back to 1970 level, and there's interest rate going up. In this scenario, the 2022 certainly will be less than what we have seen in end of 2021. And as team was trying to say that we are going to see those rainy days for sure. And there is a serious revision expected in the GDP growth forecast. In fact, US, you can see slightly the moderated growth in Q2. That's likely. And 2021 anyways was on a low base effect. So it was very high growth rate. The 2022 most of the number was before Russia-Ukraine crisis. And we still, companies and the countries are trying to understand the inflation, the interest rate risk on the economy, and that there are what you call the legacy issue from the pandemic, because most of the countries still not recovered. There's a wave of concerns coming up. So this time, the short-term outlook is certainly not looking good. And there's a serious risk of hard landing for most of the countries. And there are risks of soft landing in another set of countries. And then there are some set of countries where we can expect a moderate growth rate. But on an average, if you look at from the global growth perspective, it will be certainly down what we have seen in H1 2022.
Great, thank you. I think we have time just for one more question. Let me just read this. What can DNB offer to be able to tackle manage country risk accordingly for countries facing low foreign currency reserves with uncertainty of policies imposed which may possibly restrict trading activities and impacting relevant industries of these countries?
Yeah, so I have, I'll maybe team can provide some support from a company side, industry side, but I will, basically answer on the country side. So in DNB, we have a country advisory group, country risk advisory group, basically. And we write, in fact, report across 132 countries. It's done every month and every alternate month. Basically, it's a very comprehensive piece that's spread across 9 micro categories. When I say micro categories, that talks about short-term economic outlook, long-term economic outlook, transfer risk, exchange rate volatility risk, political risk, nationalization risk, business regulatory risk, business continuity risk, and the market potential risk. This 9 risk categories further recategorize into the 4 what we call the use cases, persona case, what we talk about: credit environment, supply chain environment, market potential environment, and the political environment. The good thing is that there's a score assigned. Each 9 categories and then 4 converted categories have a score on a scale of 1 to 7, where 7 is very risky, high risk, and 1 is basically low risk categories. And this runs across 132 countries, which means it's a very easy to use template or dashboard, other than the comprehensive report, which one can take a call on any parameter on exchange rate volatility front we talk about, whether UK is better than the India, or India is better than the China or the US, or on the transfer risk perspective, which country is better, which country is risky, the short-term economic outlook, long-term economic outlook, that again give the same perspective that which country is better, which country is not better. That's how basically we decide on the country front, that how country across these 9 categories are trending. And once we decide on the country, then how we can basically navigate through the company and the country. I think, Tim, if you want to share the company perspective, that would be great.
Yeah, thanks, Arun. And they're very tightly connected. What we advise and what we see true global multinationals and those operating in less known economies is to combine together what Arun just talked through, which is the risk or the opportunity through the certain macroeconomic topics of doing business in a country, buying from or selling to on the supply or the client side, even on the M&A side, and incorporating those variables into models and policies and decision rule sets for supply chain, as well as for customer onboarding and customer risk management. And that combination of the indicators from a macroeconomic perspective, coupled with a very clear, specific supply or client credit risk or purchasing policy, that's when we start to see companies really understanding how best to do business in a certain geography. And I think that's particularly important where you're doing business in geographies that are either new to you through acquisition or expansion, or areas that are less known to you. The incorporation of the macroeconomic factors of that territory, coupled with a tight policy at a company level, really enables companies to understand how best to do business in a certain economy, in a certain market, while doing business with companies in that space. So it's very much a marriage of the two, not one or the other. And actually, even in some of our credit risk and supply risk models at the company level, we incorporate those macroeconomic factors as part of those standard models anyway. So it's a very kind of tried and trusted approach, and it's certainly what we recommend for our clients who are doing business multinationally.
Fantastic. Thank you so much both for presenting today and sharing your insights. We are just over time, so I think time to close up the session. But thank you everyone for joining us. The recording and slides will be shared with you after, if anyone else would like to see the recording. Yes, and thank you, Tim and Arun, and everyone have a great day and rest of your evening. Thank you.
Thank you.
Thank you very much.
Thank you.